We need a way to get exposure to Bitcoin price performance, the best performing asset in the world by far, for lenders, not just investors. And that's where these Bitcoin bonds come in, because now you can lend into it. And once that issuance takes place, now the positive feedback loop is actually initiated. And what happens is the higher yields, the higher potential, the low risk, high reward, right? I like to call it the lowest risk, highest reward cash flow vehicle in the world, because that's really what it is. Because there is no limit to Bitcoin upside, because there's no limit to fiat downside. And we turn that upside performance into bond yield. So the higher potential yield creates demand. Once you issue, you have to go buy Bitcoin, higher yield, higher demand. Well, higher demand on Bitcoin equals what? Higher price, because you can't create more of it. So price elasticity, the price must go up because there's more demand for it. And then when there's more demand for it and the price goes up, that something happens. The yields go up. So when the yields go up, there's more demand for those yields. So then you issue more notes, which creates more demand, which pushes price up, which creates more demand. And there's your positive feedback loop. It just keeps going and going and going. And this is how you could recapitalize the republic. You could make Social Security great again. Or if you're not in the United States and you're a foreign government, you can take a program that you have and fund it through Bitcoin bonds.
Itadakimasu. Welcome to the Everyday Investor, everyone. I'm Darcy Ongaro. I'm delighted to be in the presence here of CJK all the way from Florida. How are you?
Hi, I'm great. Thanks for having me. It's great to be here.
So I want to get into a pretty broad discussion around everything connected to, say, macro, Bitcoin, everything in between. We're living through a period of time of intense change, right? So I just wanted to get your take first and foremost, just around your view around financial innovation. Are we likely to see that what started out in 2009 with Satoshi Nakamoto, are we likely to see that is where we're going to get financial innovation from? Or do you think that traditional finance will just take the best of the best and naturally get there anyway?
Yeah, that's a good question. I don't think we would naturally get there just because the incentives are not properly aligned. So the controllers of the system, the powers that be, so to say, I think everything works for them pretty good right now. I think if you look back here in the United States at the Silicon Valley Bank failure, pretty quick they were able to spin up the bank term funding program. Underwater banks were able to post that collateral at par value, and that eliminates the problem. So being able to print money at will, being able to have an elastic money supply with no limit on what they can do or how much liquidity can be added to the system is a big benefit to them. So I don't think we would naturally trend in the direction of Bitcoin. I think it would actually be the natural trend would probably be towards a central bank digital currency, towards a tool that these powers that be can use to not only name interest rates, but now start to control supply and demand by naming the prices of milk and chicken and eggs, and trying to control the whole economy. Of course, we've seen this in history fail 100 times. But when the candidate is coming out and saying, we're going to do price controls, you have to be concerned that this is their idea and this is the direction that they want to go.
So do you think then that if left alone, if not challenged, if we the people don't stand up, do you think that central bank issued digital currencies will be the natural evolution of centralized authority? And do you think that they'll inevitably succeed?
I think it would be the natural evolution of centralized authority, because it now gives them complete control, and they want control over resource allocation. So just naming the price of money and the interest rate is not enough. They got a little filler of that, and now they want to name the price of everything. Now they want to tell you what you can and cannot buy. I think if you look at China and you look at they have over 700 million CCTV cameras, and they work on a social credit score. And you look over at the UK, and if you retweet the wrong tweet, you can go to jail. I mean, and we're talking, this guy just got sentenced for a tweet for 20 months in prison for a tweet. So this is about control. This is about power, absolute power, and absolute power corrupts absolutely. And unfortunately, that's the natural progression. But thank God, like you said, in 2009, we have this unnatural thing come into the system. We have this engineered money, enter the marketplace. And that's why we're 15 years in. This is a big problem. And if you look at the internet, if you look at other solutions to other big problems, it took a lot longer than 15 years to get to where Bitcoin is now. So in the adoption curve, in the S curve of adoption, Bitcoin is moving at a pace that outpaces the internet, outpaces cell phones. It outpaces quite a bit of relevant technology that we all use in one form of another today. And to see Bitcoin accelerating at an even faster pace than these game changing technologies should be a strong signal to your listeners and to the world that something different is going on here. And thank God for Bitcoin, that engineered money concept, absolute digital scarcity, the difficulty adjustment, providing sustainability in downward adjustments and store value through upward adjustments. This asset is amazing, and we've never seen anything like it before.
This engineered money, do you want to break that down a little bit more, what you mean by that?
Yeah, absolutely. So I actually like to say that Bitcoin is the first money that we've truly discovered. And gold has played a phenomenal role in teaching us the characteristics of money. And now comes the technological advancement, becomes the engineered solution in tandem with technology to bring us to the next natural state of money. And if you think about it, like your listeners can kind of piece it together, the puzzle like this: like we had fire, and then we had candles so that the light could last longer in the dark. That's a very valuable solution. But then we had an engineered solution, and we went from candles to light bulb, right? We had horses. And even today in a car, what do we call it? Horsepower. So horses were, the number one way to get around. They helped build this country. But then we had an engineered solution to the natural solution, which is the car and the truck. And you look at newspapers, the printing press, revolutionary, putting ideas in people's minds, allowing people to learn to read and write. The powers that be didn't like that, but then we made that even better. And now we have strings of code that can present text to us in the digital medium. And newspapers and magazines are dying. Everybody goes online or into your app to find out what's going on. And finally, paper money with no limit and data that's manipulated by the powers that be, again, with no legal consequence or limit, now to an engineered, a technological solution and advancement to the natural form of that money, which is Bitcoin. So I love that people compare it to gold, but I would say that gold is like when you carve a bow out of a tree and you create a bow. It's going to shoot true. It's going to be powerful. You can hunt with it. But when you engineer a bow and you create it in the factory, you get the apex predator. You get peak performance. And that's what Bitcoin does. It builds up on top of everything we learned from gold to deliver peak performance for we the people.
That's awesome. So this engineered money is designed to be an improvement. Obviously, it's better, like fire, candle, light bulb, etc. Why not have a centralized authority in control of our money, though? Going back to CBDCs before, why not? Like, especially when we have a massive population globally confronted with all sorts of diseases, wars, and existential threats. Don't we need some sort of centralized authority to coordinate the allocation of resources?
Yeah, you would think that we do, and the socialist communists thought that and proved that's wrong, because actually the best resource allocator is the free market price signal. And I think a lot of people just don't study this; they don't understand it. But I'll tie it back to gold and then compare it to Bitcoin so we can piece it all together.
Yeah.
And what's really interesting is when you look at gold, when the price of gold is above the cost of production, producers make a profit. Well, they're going to reinvest that profit to expand the supply of gold. So you hear a lot of people saying, well, what if BRICS backs their currency with gold? And what if gold becomes worth $50,000 an ounce? What if they just reprice it? Well, $50,000 an ounce repricing does not increase the cost of production of gold. So what you've done is you've created an artificial profit, which the market will then take advantage of, and it will. I mean, they'll build spaceships to go fly out and get asteroids that are made of gold and bring it back if you give them that much profitability, because it's the profit that's reinvested, and you got 50,000 versus a $2,000 cost. So gold did such a good job over time of holding our value because that value was preserved through the inflationary process. And there's a difference between inflation and economic demand. And hopefully your listeners understand that difference, but the majority of the world does not. And when they hear inflation, they think economic strength. But in reality, inflation is not economic growth at all. And inflation passes through on cost of production and price. See, because now gold holds your value because they print money. We get inflation. The cost of the producer goes up. So they must pass that cost to the consumer. Otherwise, their profit margin is going to shrink. So with inflation, you get an increased cost of production, which then forces a higher price. But when you have economic demand could push up the cost of production a little bit, but really it's pushing up the market price. And as the market price goes up relative to the cost of production, producers are seeing increased profits. They can take those profits and reinvest in expanding supply. That allows them to reduce their marginal cost of production. I like to use the water bottle example. If you make 10 million water bottles, it might cost you 10 cents per water bottle. But if you make 50 million water bottles, it only costs you 6 cents per water bottle. Now, why that's important is because now you can lower your front end price because your cost went down. So you can lower the price, the unit price, but you're maintaining the same profitability, or you're even more profitable. But with the lower front end price, lower prices invites more demand. So now you're selling more units. And what do we see? More production and more consumption. That's the definition of a healthy economy. Now, if the cost of production of gold is at 2,000 and the price of gold goes below that cost of production, what's going to happen is producers are not going to produce anything anymore because there's no profit to capture. Supply will come down against a steady demand, and then that forces a higher price. And that will happen until the price goes above the cost of production, and then profit incentivizes producers to step in. So how does this tie into, do we need resource allocation? Well, because that's the free market price signal. This is how the price discovery process works. If you have the option to buy a snack, like a candy snack, and it's cost $30 for that snack, but it only costs them $1 to produce, then that's how the free market signals to producers whether or not the value proposition is equal to the price. Because if it's at $30 and you're not getting that much nutritional benefit and you're not getting taste, then you're going to say to yourself, well, that's too expensive. I'd rather just buy this apple for $2, or, this other snack that is much more fair value. There's much smaller premium in the price relative to its cost because of the value it delivers to me. And then what's really interesting here, this is the resource allocation of the free market says, if you're a producer and you're producing something at a cost and you can't sell it at a price above the cost, that is the free market telling you, yo, man, you are wasting your resources. You need to stop doing what you're doing, and you need to reallocate your resources. You need to produce a good or a service that allows you to charge a price above the cost, because that's the free market price signal confirming that the value proposition is there. And that's, we have the free market to do that. We don't need a group of men to do that. Now, tying that into Bitcoin, it gets even more interesting because this is the engineered component. The first thing is when the price is above the cost, the producers profit. But here's the thing. Like in gold, they can increase the supply. You cannot increase the supply of Bitcoin. But what can they increase? The hash rate. Okay, well, is there a mechanism within Bitcoin that accounts for hash rate? Does that affect anything within the code? Absolutely. It's called the difficulty adjustment. And every 2016 blocks, or roughly 2 weeks, the difficulty adjustment will adjust. And its sole purpose is to target 10-minute block times. So if there's a lot of hash rate, or the measurement of computational power being contributed to the network, then blocks can be found at a much quicker pace than 10 minutes. And then at the end of those 2016 blocks, we get a difficulty increase, which then makes it harder and increases the cost of production, driving the cost towards the price, which has not yet reached its value. Because that's the process. We're in year 15. We're going through what's called price discovery. We're trying to discover the value proposition of Bitcoin. It's not fully understood within the marketplace. That's the definition of opportunity. Like the early internet. Nobody understood that you and I would be able to talk from opposite sides of the world because of the internet. But they bought some pets.com because they didn't know what was going to happen. But in hindsight, it becomes extremely clear. And right now, for people like you and I, who the light bulb has gone off, it has become extremely clear that free market economics, free market interest rates, going off on a little tangent here, but it's not just about free market money in Bitcoin, but decentralized finance, which I think is going to be built on Bitcoin layer two. That is about taking away free market interest rates and putting it back in place. Excuse me, not taking away free market, establishing free
Restoring it.
market interest rates. The
Yeah.
Fed gets to state the overnight rate, and that's a way that you can manipulate the yield curve. Now, the note rates and the bonds are considered more free market because there's no direct way to affect them except through not issuing or more issuing or yield curve control, but they can't state that rate. But in Bitcoin, the interest rate is based on the supply of money and the demand for loans. So it's a free market rate based on the price signal that is controlled by the free market itself. And the market is much smarter than any group of men, no matter how hard they try. Now, going back to the price above cost in Bitcoin creating profit, they increase hash rate. Now blocks are getting faster than 10 minutes. They increase the difficulty adjustment increases up. This pushes cost towards price and drives us towards the value. What is the value? Well, the value proposition of Bitcoin, although some would say it's nothing, it's just thin air. No, that's incorrect. The value proposition of Bitcoin is, first of all, a store of value, right? It's a way to secure the purchasing power of your time and energy. Second, it's 24/7, 365 access to liquidity. I mean, there's no other
Mm,
instrument that gives you this.
that's right.
Third, how about quick, easy, cheap settlement in less than 10 minutes? And finally, trustlessness.
Mm,
Nodes trust nobody so that you and I can trust anybody on the network. So that's the value proposition of Bitcoin. And ultimately, what that means is we're talking about global GDP divided by 21 million, which is where the meme comes from, infinity divided by 21 million. Because with human intuition and creativity, the GDP is limitless. There's no limit to what humans can accomplish and achieve. So we take human accomplishment and creativity and productivity and we divide it by 21 million Bitcoin. And you will always conserve your purchasing power through that process. Now, one last thing I'll add to this is, okay, well, you gave us the example of price going below cost for gold. What about for Bitcoin? What does that mean for Bitcoin? Because we understand how the positive difficulty adjustment drives value into the network. But what about the negative? Well, I'm glad you asked, because the negative component is about sustainability, right? In the traditional system, think about COVID. What did we need to do? Well, those men needed to take action. They needed to lower interest rates. They needed to perform quantitative easing. They needed to monetize government debt. They needed to come up with all these different plans in order to remain sustainable, in order for the system to survive. But in Bitcoin, when the price goes below the cost and miners are unprofitable, hash rate will turn off as it's liquidated or relocated, and the difficulty will decrease. Well, what does this mean? This means that the miners who were properly managed through the commodity cycle and did not get over leveraged or overextended, they'll be rewarded because they'll be more profitable and they'll be buying the computers of the miners who did it wrong. So the difficulty adjustment is that engineered component that acts as a sustainability function on the downside and then as a value driver function on the upside. And we have an engineered algorithm that can do, based on mathematics only, what humans at central banks try to do based on politics and emotion and manipulated data.
Hey, pardon the interruption on this episode. We'll get back to it shortly. There's over 560 million crypto users worldwide, and that number is growing around 10% a year. If you haven't made a start yet in this space, the good news, you're still early. The bad news, each day that you delay making a start, you risk becoming late. Now, I'm not here to tell you that crypto is going to solve all the world's problems. Some of them, yes. But I just want you to consider, if you're an everyday investor, to look at crypto as part of a legitimate investment strategy. So I created Crypto 101, Crypto with Confidence. It's a free 5-part video course designed to give you a solid understanding of buying, selling, swapping, and holding crypto confidently. Join me and 4 other experts to gain the tools that you need to reduce the chance of loss and increase the odds of success. Start your own crypto journey with confidence now by taking the free online course. Link is in the notes. I'll see you there. I don't even know
Yeah.
where to start, but going back to, I guess, price controls, right? Like what you were starting off with there was just a beautiful example of how the free market effectively is the most efficient vehicle to allocate resource. Is it perfect? Depending on your perspective, probably not, but it doesn't have to be perfect. It has to be efficient. And so whenever you overlay control, man-made controls over a natural system, not through design, but through, I guess, emotion, like what you're saying, and politics and all sorts of motivations that creep in there, you get some sort of suppression or manipulation of these free market forces, which inevitably create magnified side effects that are probably actually way more damaging. Case in point, post 2020, super low interest rates. Let's crank up the quantity of supply, asset prices, goods and services, eventually wages, price spirals upwards. What's the cure to it? Higher interest rates. Why not just let the free market do what it does? Because it will probably normalize. But that's the kind of stuff that seems to happen. And now you have this engineered perfect money on the scene. It is like a light in a dark room in a sense, right? Like it actually highlights just how broken and corrupt the existing system is. Yet those who are, I guess, captivated by the existing system looks at it as the evil itself because it's so different, right? But what is it going to take before people en masse realize that we can't or we shouldn't control these natural free market forces, especially when it comes to money? Do you think it'll come to some sort of event where the system collapses and people start to choose it? Or do you think little by little, bit by bit, block by block, people start to choose perfect money over the unsound money that we currently have?
Yeah, kind of like a Gresham's law. Well,
Yeah.
first I want to address what you said about revealing um, some of the mismanagement and problems in the system from Bitcoin, because I also think, and this is interesting because candidate President Trump said in his Bitcoin 2024 speech that if he becomes president, he will look to use stable coins to expand the dominance of the dollar. At Bitcoin Energy Summit a while back, I sat on a panel. I had the honor to sit on a panel with Congressman Byron Donalds, who is also sits on the Financial Services Committee here in the United States. And he told us that the Financial Services Committee was considering the stablecoin bill here in the United States as a way to create demand for treasuries, because according to the bill, the stablecoins need to be backed 1-to-1. Now, there's a dilemma that's created here because our fractional reserve banking system is backed. Well, it used to be backed 10 cents for every dollar. Now it's probably backed 1 cent to every dollar. And it does vary between banks because it's based on that bank's risk profile, and it's also based on that's bank's interpretation of Basel banking policies. So those couple of reasons will make a bank deposit be backed between 1 cent and 10 cents, at least here in the United States. Now, stablecoins backed 1-to-1. So if they made this bill, if they passed this bill, something really interesting is going to happen here in the United States. You are now going to give the marketplace an option. You can now hold a bank deposit backed by a penny to 10 cents. You can't access it 24/7. If you need money on Sunday, then you better come on Saturday in between hours to hit the ATM. By the way, when you take $100 out of the ATM, we're going to charge you $4 to do that, 4% to just get your own money, versus a stable coin. Hey, this stable coin has a legal requirement. Now, it doesn't right now, right? They have to pass the stablecoin bill first. But if they do, it would have a legal requirement to be backed $1 to $1 in liquid US treasuries. Next, you have your own self custody of the stablecoins. You have access to 24/7, 365 liquidity, just like you would with Bitcoin. And you don't have to ask anybody's permission. If you need it on a Sunday morning, no problem. Sign the transaction. So that also reveals a lot of the problems. Stable coins reveal a lot of the problems in the fractional reserve model. And the
Right.
and the long-standing thesis has been, well, if you have a fully reserved bank, you can't make money. Yeah, but look at Tether. Tether has 25 people. They made $4 billion. Morgan Stanley has made $4 billion, but they have over 40,000 employees. You see, so yeah, you actually can make money with a fully reserved banking model. And I think that's why the Fed has shown discrimination towards Caitlin Long and Custodia Bank, because she has that full reserve model. If she got a master account at the Fed, every single deposit in that ecosystem would flood to her bank because it'd be backed 1-to-1. And they wouldn't have to depend on the FDIC. They wouldn't have to depend on the bank term funding program. So there's a lot of disruption that's coming from this marketplace, not just from Bitcoin itself. Now, the second thing you said was, what's going to be the catalyst to kind of accelerating this switchover? Or is it going to be a realization moment? Is it going to be a failure? And in my opinion, I think we are entering into a time frame that is going to be worse than the Great Depression. Now, let me explain what I mean by this, because a lot of your listeners are probably saying, "Ooh, worse than the Great Depression. That means prices are going to go down." Well, no. You and the other people who are holding $6 trillion on the sidelines waiting to buy the dip isn't coming. The dip is coming to your purchasing power, not to asset prices. And that is the big catalyst that needs to change. That's the big understanding that needs to change. And in my study of fiat currencies, I have found that even though the economic textbooks try to define inflation mathematically, it's different based on the economy. It's different based on the society and the culture. And there is no way to mathematically define from when you go from inflation to hyperinflation. But you know what? The one thing that they had in common across all societies, all times, all cultures, and all economic systems, a loss of trust. People didn't trust the powers that be anymore. And it was the loss of trust that was the catalyst that shifted us from inflation to hyperinflation. So as we move into what I call, or I think is going to be a time frame that is worse than the Great Depression, why will it be worse? Well, let's think about this for a second. If you had a lot of dollars on the sidelines and you had your savings in dollars, and we went into a time frame of Great Depression and prices came down, you'd be able to buy more. So that's part of the natural business cycle. These recessions and depressions are the free market's natural way of kind of resetting the system, resetting growth, punishing malinvestment and mismanagement, and starting from a stronger, healthier point. Inflation doesn't let that happen. That's why we have zombie companies in the stock market. That's why we have prices that are basically unaffordable at this point. But we have not seen anything yet. What's coming down the line is that prices are going to move so fast, so high, so much further than people can anticipate or are anticipating right now, that we will go into a hyperinflationary depression. And even though you're making more money, even though everybody is going to be a millionaire, nobody is going to be rich. And your quality of life and your standard of living are going to plummet because affordability is going to plummet. And there's no amount of demand destruction that can stop it from coming, because it's not coming from the economy. It's coming from the abuse of the currency. And now that's where Bitcoin comes in. You cannot abuse Bitcoin. Bitcoin has an absolute digital scarcity. It's a finite supply. It will not allow you to create inflation. And then if you try to create inflation like FTX and Sam did selling paper Bitcoin, when that time of reckoning comes, nobody can print the Bitcoin for you. There's no bailout coming. You have forced failure. But in an economic system with mismanagement and malinvestment, forced failure is a benefit. It's a short-term pain for a long-term gain. All of the printing that we're doing in the current system doesn't allow that destructive process of the natural business cycle to take place. And every time we have a crash, prices crash up, purchasing power crashes down. And this next crash is going to be a move from what we're in now, which is an inflationary recession, to what I believe what will be called a hyperinflationary depression. And that could be the moment that trust is lost. And if it is, the dollar will end up worthless in the streets. Now, I hope and pray as an American, for the sake of my children, for the sake of our quality of life and standard of living, that this doesn't happen. And I think that's my main vote. I'm a one issue voter, and I'm going to vote for Trump because, number one, he's going to keep Bitcoin as a strategic stockpile. That's going to strengthen the asset side of our balance sheet. All we have on the asset side of our balance sheet is our economy. There's not much over there. We're not allowed to tap into the oil. That's another reason I want to vote for him. He said we've been one of the lowest cost energy producers in the world, which would also make us a Bitcoin mining powerhouse, which we'll get into later, helps us with issuance of Bitcoin bonds. But all of these things come together, and I do believe there is a future where the dollar and Bitcoin can come together to create a powerful, strong economy. And fair economy, not only here in the United States, but across the world. So that's my hope and my prayer for the sake of our quality of life and living standard. But no doubt, just ask yourself a question. Do you trust your government more today or more yesterday. You know what I'm
I
saying?
don't want to
The
get
trend.
arrested. I don't want to
Yeah.
get arrested. So I'm going to stay quiet on that one.
There you go. The trust trend is clear. And at some point in time, nobody knows, not me, not anybody, but at some point in time, that catalyst is sparked. And if it's a hyperinflationary depression, well, then trust will be lost and Gresham's law will take place. And Bitcoin is the fastest horse in the race.
Sure. So it's kind of like a picture of those like really super fast boats on the water. As soon as they get to a certain point where they're going so fast, the resistance from the wind or whatever, the lift flips them over in an instant, like in a twinkling of an eye, right? It's all over. And that's I guess that's the challenge is that it's never happened before. Kind of like this Noah's Ark situation. It'll never happen. It's never happened before. Why would it, well, you're crazy. You're an absolute nutter by suggesting that there's going to be hyperinflationary depression. There's no way. But I think what we're missing is the fact that it's little bit by little bit, and then it reaches a critical point, which it effectively just goes straight up.
Yeah.
And that to say that that can never happen is probably the epitome of hubris. It's just you're really in a dangerous place when you assume like you have possession of all the truth in terms of how it can happen. And even you've alluded to that is that you hope and pray that it doesn't happen. You think it's going to happen. I guess anything could really happen. Um, but it's impossible to measure the system from within the system. And I think that's what people really struggle with. They're so focused on the numerator, they forget that the denominator to all this wealth is the thing that's being inflated. And that's why we get all these distortions. And so we kind of just assume that, oh, we'll just eventually evolve and move around here. But this is a little bit by little bit all at once sort of risk that we have to deal with. And yeah, Bitcoin, like to me, it kind of feels like it's obvious. It's a digital version of a solution that people could migrate some of their wealth into right now to prepare for what might happen. We don't know when it'll happen, but I guess it's the value of that denominator is linked to the aggregate trust of everybody in the system, right? And right now, most people have no idea what we're talking about. Would that be fair enough to say?
Yeah, absolutely. And I wish it was a Noah's Ark moment where it had never rained before and they were laughing that he was building this thing because water is going to fall from the sky and it's never happened before. But it happened in Greece, it happened in Rome, it happened in Weimar, it happened in Venezuela. It's happening now here. So there's precedent for this. And like you said, the level of hubris to pretend that it can't. Look, Rome is widely known as one of the um, most powerful and expansive empires in human history. And they even had real money. They even had silver, right? And
Yeah.
they diluted the silver denarius from 90% silver to less than 5% silver at the fall. And so it doesn't matter whether it's paper or it's actual physical metal, the consequences of that dilution, the consequences of the state stealing from its citizens will always at some point lead to a loss of trust. And that is the catalyst to the failure of the entire system itself.
Got it. Wow. Okay. I'm just past my first point here, so this is good. We've got another 20 points to go, but we'll see how far we go. Uh, when I first discovered Bitcoin, I was probably like most people initially. I thought it was a scam, it was a joke, wasn't real, couldn't be real. It was in the internet. Then I flipped to thinking, okay, it's just a high risk asset that I can invest in. I get it. I'm going to get some of that. That's great. And then my thinking evolved even more. No, actually, this based on what we were just saying, this is actually a safe haven asset in the digital realm that I should be accumulating in. And I think it's interesting how Fidelity, BlackRock, large fund managers, Larry Fink, even politicians are now starting to get on the bandwagon. But again, they're in the number go up mode, right? And if they really knew what Bitcoin is about, not what they want to make it about, they would probably be a little bit more cautious. Do you think that it's kind of like almost like a Trojan horse sort of concept here, where Bitcoin from within that traditional finance system will eat it alive because they've let it in? Or do you think that maybe they have a chance at suppressing it somehow, creating paper Bitcoin?
Well, you're always going to be able to create paper anything, right? We've already seen FTX with paper Bitcoin, but it comes back to that destructive part of the cycle. You can't print the extra Bitcoin to make up for your mistakes. So I don't think I do think it's going to be a Trojan horse type thing. The reason for that is just because the system has worked so good, and has worked for so long, and it's why people aren't even aware of what's really going on. But the other thing is we're in year 15. Bitcoin is really only a store of value, and if you think about gold, gold became a store of value over hundreds of years because people tried to use a whole bunch of different things to store value. And the number one thing that you're looking for is scarcity because you can store that value. Um, but it took hundreds of years to become a store of value. Bitcoin is already a store of value within 15 years.
Mm.
Then what broke up around banking was turning it from a store of value to a medium of exchange, right? Because you couldn't have monetary velocity with gold. The monetary velocity was limited because if you want to spend micropayments, it just takes too long. So velocity was limited. So what did we need? What did gold need? It needed a layer two solution. Isn't that interesting? Because
Yeah.
that layer two solution ended up being debt notes written against or bank deposits, which is writing a check against the gold. So that layer two solution is what turned gold from a store of value into a medium of exchange. Very quickly afterwards, after its huge adoption curve, because of the ease of use of becoming a medium of exchange, it became the unit of account. Now, Bitcoin is only store of value. And that's the opportunity in the marketplace. For those of us who understand it's not just a store of value technology, it's also a medium of exchange and unit of account. Well, we're getting to buy it at commodity value. We're getting to buy it when price is moving relative to its cost of production. But after we move from commodity value up the S curve of adoption to monetary value, that's when we get the global GDP divided by the 21 million. So that's the actual definition of the opportunity at hand. That it's misunderstood. That we're so early on that we're in the store value phase. We don't even have medium of exchange and unit of account yet. But I do believe that some L2 solutions coming down the road, and I don't think there's going to be one champion. I think it's free market, and each solution is going to cater towards a different problem in a better way. So you have Lightning, you have Liquid. I think Stacks is going to be pretty popular with their SBTC solution. So all these different solutions, and there'll be new ones too that pop up. And these different solutions will fix the problem of medium of exchange. And as soon as we do that in a way where people can use Bitcoin like they can dollars, then you're going to have accelerated adoption, which then brings in that unit of account. Now things are real. I mean, they've already been going unbelievably fast. The rate of, like I said, we're outpacing all different technologies adoption curves. Uh, so we're already outperforming. But when people start to figure this out, and it looks like they're figuring it out now. When I started in Bitcoin over a decade ago, this was like a laughing. If you said something like countries will be mining Bitcoin and presidential candidates will make it part of their campaign policies, you'd be laughed out of the room. And
Yeah.
now it's a reality. So the speed of adoption, the speed of recognition is even faster than cell phones and the internet. It's truly amazing. So I do think it's going to act as a Trojan horse because it's hitting so hard and hitting so fast. And then on top of that, you have the ingenuity and creativity of companies like People's Reserve who are bringing these new products and services to the market that have never before been seen, such as our Bitcoin bond and our self-repaying mortgage. Now you start
Okay.
talking about those products, traditional debt products, integrating this new Bitcoin product, this new store of value asset, this new engineered money, and it can really flip the entire system upside down and catch it off guard. And
Mm.
and when it does, um, Bitcoin is going to go to prices that people can't comprehend right now because they just don't make
Yeah.
sense right now because
Yeah.
everybody's stuck at that commodity level. How much does it cost to produce Bitcoin? The price goes up, the price goes down. It's a traditional commodity cycle. But
Yeah.
at monetary value, you only have 21 million. So all economic value has to be divided over those amount of coins that are circulating, and it's going to be an extreme amount of value per coin. And once we get to that point, things are going to become much better because Bitcoin and an equity-based system drives you to treat your fellow man better. It drives you to deliver value, to receive value. In our current system, we see custodial arbitrage from the banks. We see it from the insurance companies. They're extracting value. So that's one of the things I'm most excited about, flipping the script and going from value extraction to value delivery.
Instead of risk transference, risk sharing, debt to equity. So tell me a little bit about People's Reserve. and then I want to get into Bitcoin bonds and just like, what does that even mean, right? So what is people's reserve?
Yeah, and you know what? Before I get into that, I realized I skipped over that risk part because I do want to touch on that, and
Okay.
that is that because like you said, most people look at it as a risk asset, and the truth of the matter is that it's a savings technology. So people ask me all the time, "Oh, how much Bitcoin should I invest in?" And I say zero. You should not
Hmm.
invest in Bitcoin. You should save in Bitcoin, and you should have 100% of your savings in Bitcoin. And now, if you want to take a portion of your savings and go out the risk curve and make some investments, well, then that's fine. You can go ahead and do that. But the vast majority of your savings must be held in Bitcoin. Your savings starts at 100%. And then your wants and your needs and your investments draw down from that 100% because Bitcoin is the risk off asset. The 10-year CAGR is 60%. That's much more than the 4% you're going to get in any note or government bond. So the real risk rate of return, risk free rate of return is actually Bitcoin. So thank you for letting me tap back on that because I want people to
Yeah,
understand that
that's good.
Bitcoin is risk adverse. It's not risk on. It's
That's
built,
great.
it's designed, it's strategically designed to leverage the natural economic cycle to empower we the people, which makes it the lowest risk asset. And People's Reserve is built around that ideology. People's Reserve is built. Bitcoin bonds and self-repaying mortgages are powered by Bitcoin, the most pristine form of collateral in the world because of its engineered design. And that realization is what the banks and pretty much every other company in the marketplace is missing right now. You can borrow against your Bitcoin right now for 12%, I think, 14%. What? Are you kidding me? So hold on, let's get this right. I can walk into a bank, show them my income statement, and then make them a promise that I'm going to continue to earn that income, continue to work. And then, based on that promise, with no collateral and just an income statement and a credit score, you're going to loan me a whole bunch of money at 6 or 7%. But now I take my Bitcoin, I take $1 million of Bitcoin to a custodian, and I say, I'd like to borrow $500,000 against this Bitcoin. So they have a fully over collateralized loan where if I walk away and never talk to them again, they don't care because they're not going to lose any money. And you want to charge me 12% or 16% for that? That's not how interest rates work. Part of interest rates are the supply demand dynamic in a free market, but the other part of the interest rate is the risk profile. That's why they give you a credit score to try to gauge the amount of risk on you because if you have a lower credit score, you're a higher risk, so they need to charge a higher interest rate. And we don't see that today. We have a zero risk. Like imagine if you were a lender, if you came to me and said, "Hey, I'm going to give you $1 million of Bitcoin. You hold it. You got the keys. Give me $500,000 cash, and I'll take it at 2%." Well, then I'd be like, "Yeah, sure, no problem, dude. I mean, I hope you don't come back. I just got Bitcoin, right?"
Yeah.
There is no risk here. It's an over collateralized lending market, and we're paying higher rates. It doesn't make sense. But that's because the companies themselves are either number one, performing arbitrage because they're borrowing that liquidity from a liquidity partner at a certain percentage rate and then flipping that loan to you. And then so they have to charge more than what they're paying to borrow the money. At People's Reserve, we use our own liquidity. We don't have to tap in to other people's liquidity at a rate. So that's how we can beat those rates. And then the second thing is they look, it's about value extraction, right? It's not about helping you unlock the trapped equity in your emerging digital asset class, in your Bitcoin asset. You have all this wealth, it's in the internet economy. You can't bring it back to the real world unless you sell it and create a tax obligation. Elon Musk can borrow against his Tesla shares, but I can't borrow against my Bitcoin. Bitcoin's much less risky than Tesla shares. So the understanding within the marketplace of companies and of bigger banks is just way off, and can you really blame them? I don't blame them too much. We're only 15 years in. Very few people truly understand what's going on here, but People's Reserve happens to have a team that understands, we think, exactly what's going on here, which is Bitcoin is the most pristine form of collateral in the world. So when you come and post that as collateral with us, we can do you a favor. Since you lowered our risk so much, we're going to lower your interest rate. And that's the essence behind the self-repaying mortgage. You can come to us to get your mortgage and you're going to post Bitcoin as collateral. Now, here's the kicker though. You're not borrowing liquidity against the Bitcoin, right? That's a really important concept to understand.
Okay.
When you post your Bitcoin with us, we are not rehypothecating that Bitcoin and borrowing against it for you. That
Right.
Bitcoin is simply sitting there on chain, protected, where you can see it 24/7 to make sure it hasn't moved. And it's only there to reduce the risk of the mortgage, right? And then if something happens and the value of Bitcoin goes down and you breach your loan to value agreement, well, then now you have a choice. You can add more margin to maintain the contractual agreement, or you can actually just liquidate your Bitcoin. But when you liquidate your Bitcoin, this is not a 100x leverage trade. You don't just lose because you got liquidated. You liquidate your Bitcoin to close the loan. Congratulations. You now own your home free and clear. You now have no mortgage payment and you just bought your first home.
Can you
So,
just walk me through this, like just practically? So we're talking about self-repaying mortgages, but we're saying that because we're staking is probably a pretty loaded word, right? We're depositing our Bitcoin in some sort of vehicle, and you can see it on chain, so we know it's not being moved around and rehypothecated. But because you're doing that in somebody else's possession, people's reserve in this case, you're reducing the overall risk profile significantly, which means that the credit risk effectively is going way down so that you can create lower rates. How, like from a just practically outworking this, if I was to go and take out a mortgage right now to buy a home, completely different process. Are you imagining that this is, or maybe this is already happening? Does this work where we're replacing uh, traditional finance mortgages, or is this an alternative vehicle for people to raise funding for their home?
no, this is absolutely an alternative vehicle. This is not going to replace mortgages. And the reason that you would do a self-repaying mortgage is because you're going to get a lower interest rate. So right now in the
Sure.
United States, if you go to get a mortgage, depending on your credit score, you're going to be somewhere between 6 and 8%. Your strong credit score, you'll be down by 6. Weak credit score, you'll be up by 8 if they even give you the money. But a mortgage is a great deal because where we're heading right now, I would love to have a 30-year mortgage. Sign me up, because even at 6 or 7%, or even at 8%, I don't care. Sign me up. I'll refinance later when they're forced to lower the rates. Because let's say my monthly payment is $5,000 a month. Well, 10 years from now, 30 years from now, I might be able to just go outside and pick $5,000 up off the ground. Right? Look at Venezuela. You can go pick 5,000 off the ground. So if I can go in 10 years or 15 years or 20 years or whenever within any time frame of that loan, if I feel like I can go out to the curb and pick the 5,000 up off of the street and then walk into the bank and pay my mortgage payment, that's an asset to me. Right? And that kind of, people are like, "Well, wait a second. A loan is an asset? I thought that was a liability." Not in this type of economy. Not when the rate of inflation is greater than the rate of interest being charged. That creates a positive benefit for you in terms of purchasing power. The burden on you is going down over time. So I think it's important for people to remember that a mortgage is a really good deal. If you can get it, take it. But a lot of people aren't going to be able to get the mortgages, and a lot of people also don't have Bitcoin. So this is really built catered towards the Bitcoin community. And a lot of people on our team are all facing the same problem because we've been in the industry for a while and we're looking to unlock our trapped equity in Bitcoin and make it more usable. Not that it needs to be, but we're just trying to be as efficient as possible with our assets. And this is one way where we can get access to money for the cheapest rates in a low risk, high reward way. And not only for the borrower, but for the lender as well. Because when you go into the marketplace and you say that government bonds are the risk-free rate, I have people ask me, "Well, why would you lend money at 4% or 5% when you can lend it to the government and get more?" Well, because the government bond is not the risk-free rate, man. The first thing that's going to happen is, yes, they can print the money and give it to you, so I'm going to get paid. But when I get paid, I don't know what the hell I'm going to be able to buy. That's called the inflation risk. Now, when you look at the United States, we have two. I mean, it has never been so divided in this country. It is probably my biggest concern. My biggest short-term concern is civil unrest and fallout from the election, because a lot of people who are conservatives feel like the 2020 election was stolen. So if it gets stolen again, I'm not sure it's going to be like that peaceful J6 moment, right? And you're going to get real patriots to go to the Capitol. There's going to be a lot more shooting, and it's going to last a lot longer than one day. All right. That's what happened if real patriots went there. Now, look, they won in 2020, and they still came after those peaceful protesters. They won, and they still came and attacked. So what's going to happen if they lose? I don't think any rational person can sit here and say one side's going to turn to the other side and shake hands and say, "Hey, good job, man. We'll get you next time." I don't think so. We're seeing the Civil War rhetoric move up. A lot of people are talking about. I saw Mark Cuban on Jon Stewart, and he was joking about Elon Musk commenting under a Civil War comment where it said Civil War is inevitable, and Elon Musk said, "Hmm," and then Jon Stewart was like, "Oh, that must be that's an understatement." So and then the whole audience laughed like Civil War is a laughing matter. You want to fight against your family? There's so much. It's just a disgusting thought. War is hell, and we should avoid it at all costs. And Bitcoin helps us do that. But we are so divided right now. You know what it does? It creates a civil war risk. What happens? The last time this country went into a civil war, the South could not bank with the North. They could not bank with their enemy. So they had to create the Confederate debt notes, the Confederate currency. And there was an economic divide. So that's not priced into U.S. Treasuries right now. Civil unrest or federal government fallout post 2024 election is not priced in at all to U.S. Treasuries, and it is absolutely a non-zero risk. And that's do I want to loan my money to the government? Well, I have a question for you. What happens if we have fallout? Who's in charge of the Treasury? What if the conservatives say we're in charge, and the liberals say no, we're in charge? Well, who's actually in charge? How do we settle this matter? Does it matter that the conservatives don't have the existing power of the law, right? Because the election's in November, but the transfer of power isn't until January. So what radical actions will be taken by those who do have the power of the law between November and January? What will they do, and how will they use the law against us? And I think, in 2020, we saw how all governments will use the law against the people. So I don't want to lend my money to the government. I don't care if I'm getting a few extra basis points. It's not worth the risk. I'd rather lend it to a Bitcoin holder who's posting Bitcoin collateral and borrowing less against the Bitcoin than they posted as collateral. I'm happy to do business with you, and I'll take a couple hundred less basis points because my risk has been eliminated. So I think that's the big difference here. Once you get your hands on Bitcoin, you start to look at risk way differently. If I risk my dollars, I don't really care. If I'm risking my Bitcoin, I'm going to pay more attention here. And when I'm risking Bitcoin equity, I'm going to be like an eagle. I got eagle eyes on this. I want to know exactly what my risks are. I want to know exactly what could go wrong. And I want to know how to take advantage of the situation. So People's Reserve is, it's a win-win. It's a win for the lender and it's a win for the borrower. And it's a more secure alternative solution to existing mortgage, not a replacement.
Okay. So it's really just the collateral that's securing the loan. So instead of placing security over the home, it would be placed over a stack of sats. Is that
It's
what you're
actually
saying?
both. It's actually both. So there'll be a lien on the property, and your Bitcoin will be posted as collateral.
Yeah.
And then if you want to liquidate your Bitcoin, or if the price of Bitcoin goes down and you breach that loan to value ratio, you have two options. One, you could allow the interest rate to increase, right? Because as the equity value of Bitcoin decreases, our risk increases. So you can accept a higher interest rate, or you could post more collateral, or you could liquidate the Bitcoin. We release the lien on your home. Congratulations, you own it free and clear. So it's just a solution to protect both lender and borrower, and to give Bitcoiners who have been responsively saving in Bitcoin the ability to unlock some of that trapped equity to increase their quality of life and standard of living in the real world, and try to benefit from some of that digital wealth that they've been so responsible to build up.
Okay. I get it. Where does the self-repaying part come from?
So the self-repaying part comes from what if Bitcoin price goes up? So we went towards the scenario of the Bitcoin collateral going down in value. But what happens if the price of Bitcoin triples? And now your threshold is way beyond your loan to value requirement. Well, now it's basically a self-repaying mortgage. You can sell a portion of your Bitcoin and just pay off your loan. So that's the self-repaying portion of it. When Bitcoin does what we think it's going to do and it goes up in value, you can save hundreds of thousands of dollars in interest depending on your loan size, but you could
Sure.
save hundreds of thousands of dollars in interest costs by allowing the appreciation of Bitcoin to close that loan and pay down principal
Sure.
to eliminate those interest costs.
And I guess there could even be some sort of reverse dollar cost averaging, i.e., just set up an automatic withdrawal, like liquidation mechanism where it's $5,000 per month of Bitcoin that's being sold. So effectively, you're never subject to whether that 60% compounding annual growth rate persists into the future, or even if it's just 20%, doesn't really matter. It's still going to be an amount sufficient so that your stack's still going to grow in value while those mortgage payments are being made from that appreciating asset as well, right?
Absolutely. Absolutely. That's probably the really smart way to do it so that you can
Yeah.
take advantage of uh, the growth of Bitcoin. But
Yeah.
again, some people don't want to give up any of their Bitcoin and they're happy to keep making those payments. Again, it's an asset, right? Like we have the dollars, we're looking to earn more dollars. You have the Bitcoin, you want to keep your Bitcoin, but you need to bring forward the purchasing power of your Bitcoin. You can do
Sure.
that at People's Reserve. And
Okay.
uh, so that's the self-repaying mortgage. Now,
Yeah.
the Bitcoin bond is a completely different product.
Hmm.
And it's actually a principal protected note, but when people hear principal protected note, they go to sleep. So Bitcoin bond is a much more fun way to describe what's happening here. But it's also a Bitcoin bond because the yield of the bond is produced by Bitcoin itself. So a lot of people hear Bitcoin bond, they probably think of Samson or Max Kaiser and El Salvador and
Yeah.
Volcano bonds.
Yeah.
And from what I understand, they want to borrow Bitcoin and then pay Bitcoin denominated interest, which, you can run into some issues with that because the appreciation of Bitcoin is so rapid that that interest liability can grow on you and could bankrupt your model. It could break your model. So I wish them the best of luck, but our idea is that we want Bitcoin to actually we want to flip the script and allow the performance of Bitcoin to empower the bond, not to create a liability within the bond. And the way that we do that is, and I'd like to use the example of Social Security, if you don't mind, because here in the United States, Social Security is probably the largest problem as far as our costs go. It is the number one largest cost item, not only in our working budget, but out of the $217 trillion of unfunded liabilities, Social Security is a really large chunk of that. And the problem with that is that the Social Security fund, it owns a lot of government debt. It owns government notes and government bonds. But these notes and bonds are actually yielding real negative returns. So, yes, in a nominal, for your listeners, I hope they understand the difference between nominal and real. If they don't, I'll give a quick breakdown.
Yeah.
Nominal is
Please.
just the number on the screen. If you're getting 5% from the government, then you will have a number that is nominally 5% larger than what you started with. But real interest rates are accounting for purchasing power. So, according to the government right now, you can get 5% in your bill, but the inflation rate is 3. So, at the end of the year, you got 5% more money, but things cost 3% more. So, in terms of purchasing power, you're only going to be able to buy 2% more stuff. Now the problem is that inflation is not 3%. And when you
Yeah,
go
that's right.
back to the pre-substitution equation, this is the government equation, not CJK, but you can go to govflation.com to follow these statistics where we go back to the government financed equations. They created the equation, it was their equation, they used it, and then they changed it. So we go back to pre-substitution, to pre-change, and inflation is over 10%. So now you're getting 5% on your bill, inflation is 10%. 5% minus 10% is, yes, you'll have a 5% larger number, but things cost 10% more. So now you can buy 5% less stuff. And that's what's happening in Social Security. They have to continue to raise the full retirement age, and they have to continue to reduce the inflation adjusted benefits so that the program can be sustained. And what's really amazing is I did a deep dive on this. In 1982, the year before they changed the methodology, the average Social Security payment was $419. Today, the average Social Security payment is $1,800. Well, do you want to know why the government is incentivized to understate CPI? Because if they stayed with that same 1982 methodology, the average payment for Social Security today would be $11,400. Social Security alone in 2024 would cost the US government 9.5 trillion. We collect about 4.5 and we spend 6.5. But if we didn't change CPI methodology, we'd be spending 9.5 just on Social Security. So it's almost out of necessity that they need to lie about CPI, because the cost of living adjustment for Social Security is based on the CPI. So that's just one of the main reasons that we see that took place, because it wouldn't be sustainable if they weren't understating the inflation rate. But now you look at Social Security and you say, how do you fix this problem? Well, People's Reserve, Bitcoin bonds now enter the scene. Here's how you fix the problem. You take the Social Security tax and you buy the Bitcoin bond issuance. Now, what does that mean? Let's say the US government does $100 billion Bitcoin bond issuance. That means they're going to need $20 billion worth of Bitcoin, because they're going to sell that Bitcoin into the bond fund. And then the other $80 billion would go into US government debt. And what happens is, after the 5 years, the Bitcoin bond is a 5-year principal protected note. After the 5 years, the government debt matures. Well, when it matures, the 800 or the 80 billion turns back into 100 billion. So your principal is protected. The Social Security fund lent 100 billion, and at the end of the 5 years, they have 100 billion. So even if Bitcoin goes to zero, which it's not going to, but let's just say it did, they didn't lose any money. Their principal was protected and secured by the government debt.
On a nominal basis.
Yeah. On a nominal basis, yes. Now they'll still get hit with the negative real perch, but they're dealing with that now. So what's the point? We gotta try to fix this thing, right? We can continue to deal with the same problems, or we can attempt to innovate. And now, if they accept that innovation, if they go forward with this product, what's left over is the $20 billion worth of Bitcoin. Now, what's really interesting is, let's just say Bitcoin does something unprecedented and it goes down negative 50%, right? That sounds weird to us. Over 5 years, Bitcoin goes down negative 50%. No, maybe over 5 days, but hell no, not over 5 years. There's no precedent for that. But let's just say it did. Well, that 20 billion is now worth 10 billion. Well, 10 billion out of 100 billion is 10%. 10% divided by 5 years is 2%. So in simple interest terms, you're getting 2% APY if Bitcoin goes down 50% over 5 years. Now, what if Bitcoin price just stays the same over 5 years? You got the 20 billion, that's 20%, that's 4% APY. Well, in 2023, the Social Security fund, the average effective interest rate of the funds was 2.4%. So if you issue a Bitcoin bond and you put this in practice, and Bitcoin price just stays the same, and I know we're going to get into the positive feedback loop, because price can't stay the same once you start this. But even if it did stay the same, you are now out-competing. You are now outperforming. You're at 4% APY versus the 2.4% you're getting now, which means you have less negative carry, which means the program becomes more sustainable. But now, what if Bitcoin does what we know it's going to do? What if Bitcoin really starts to perform? What if over the next 5 years it maintains its 60% CAGR year over year? Well, by the end of that, you're talking about a 10x in price. That 20 billion now turns into 200 billion. You're now that note is now maturing with 300 billion, or 200%, which is 40% APY. We didn't just save Social Security. We can now increase benefits. We can now increase the quality of life and standard of living provided by Social Security. And by the way, this is not just a fix for the federal government. If you'll allow me, I'd love to dive into the insurance example.
Yeah,
because what happens here, especially here in Florida, we had a huge hurricane. Well, insurance companies are collecting our premiums and they're putting them in U.S. government debt, and they're getting that yield. But there's a problem. The real rate of return is negative. So when I paid you my premium in the beginning of the year, and then I get hit with a hurricane at the end of the year, it costs a lot more money to fix at the end of the year versus the beginning of the year, because the rate of inflation is increasing costs. So insurance companies are also carrying with a negative yield. And that's why insurance prices are going up significantly, because they raised interest rate prices. And now when an insurance company has a claim come in, they have to lock in a loss. There is no insurance term funding program. right? There was the
Yeah.
bank term funding program. They have to sell the treasury, which means they lock in the loss from the interest rate difference because they can't hold it to maturity. And that means that not only do you have to pay more to fix the claim, but now you've locked in a loss on what was your collateral. So the whole custodial arbitrage model breaks down. And an insurance company that would invest in Bitcoin bonds, this is really important because remember, you have your principal protection. So yes, in real terms, you still have a little bit less purchasing power, but it's no worse than what you have now, which is still negative carry. But the upside, the reward to that risk is now that you can outpace inflation. You can now have a bond that can pay 8%, 10%, 20%, 40% over that time period. So now at the end of it, when that claim comes in, your company is still profitable. So I think products like this, like Bitcoin bonds and self-repaying mortgages, are just the start. And we're going to see a whole bunch of innovation on these traditional products once the marketplace realizes it. But for now, People's Reserve is the first market mover because we're the first ones to actually realize it and build a product. Everybody's
Sure.
busy digitizing TradFi debt, and we are building new products, new debt products built around Bitcoin equity. And I couldn't be more excited about it.
But this positive feedback loop, because we're dealing with a truly finite supply, uh, it matters, right? How does that actually play out in terms of this circular? You know, it's an amazing thing. Like, yes, you could call it a pyramid scheme, right? Or not really a pyramid scheme, a Ponzi scheme. But hey, welcome to finance, right? Everything's a Ponzi scheme. It's just that this one's actually better. um, how does it work? How does it work?
Yeah, so I love the idea from Parker Lewis of price elasticity. And, Bitcoin, it can't be like a Ponzi because if someone needs more access, the price goes up. And when the price goes up, that expands, that'd be like creating more dollars, right? Because
Yeah.
the purchasing power increases. So really, when the government is deficit spending, what they're looking for is an increase of purchasing power that they have not yet earned. Bitcoin can deliver that through its performance rather through dilution. So I love that concept of price elasticity. But
Mhm.
what that does is it plays a huge role in the positive feedback loop that we see. And when you issue a Bitcoin bond, what's going to happen is the higher yields are going to create higher demand, right? So when you tell somebody, hey, you can invest in Bitcoin and it can go up 10x, and they go, yeah, but if I invest, it can also go to zero and I lose everything. So let me tell you something, son. A lot of people I talk to, let me tell you something, son. I've been in this game a long time, and there's a big difference between lending and investment. And you're talking to lenders, not investors. We want to lend. That's our job. That's what we're authorized to do. Some people in the marketplace, like money market funds, are not allowed to invest at all. They can only lend. So we need a way to get exposure to Bitcoin price performance, the best performing asset in the world by far, for lenders, not just investors. And that's where these Bitcoin bonds come in because now you can lend into it. Well, once this starts, and by the way, some really exciting information. People's Reserve is talking to two different sovereigns right now about this product and this tool. So this is this is going to move a lot faster than people
Yeah.
anticipate. And we've been building this stealth for over 3 years. So it's been hard to keep my mouth shut, but this is going to hit hard and heavy and fast. And I think the whole that Trojan horse moment. Once the Trojan horse is inside, and then people start popping out of it, everybody's like, "Whoa, what's happening? What's happening?" Like we're entering that moment very soon. We plan for that first issuance to be in the first quarter of next year, so we can be excited for that. And once that issuance takes place, now the positive feedback loop is actually initiated. And what happens is the higher yields, the higher potential, the low risk, high reward, right? I like to call it the lowest risk, highest reward cash flow vehicle in the world because that's really what it is. Because there is no limit to Bitcoin upside because there's no limit to fiat downside. And we turn that upside performance into bond yield. So the higher potential yield creates demand, right? And then what happens is once you issue, you have to go buy Bitcoin, higher yield, higher demand. Well, higher demand on Bitcoin equals what? Higher price because you can't create more of it. So price elasticity, the price must go up because there's more demand for it. And then when there's more demand for it and the price goes up, that something happens. The yields go up. So when the yields go up, there's more demand for those yields. So then you issue more notes, which creates more demand, which pushes price up, which creates more demand. And there's your positive feedback loop. It just keeps going and going and going. And this is how you could recapitalize the republic. You could make Social Security great again. Or if you're not in the United States and you're a foreign government, you can take a program that you have and fund it through Bitcoin bonds. Because over time, you're not going to get that negative carry. You're going to have a positive carry. And that's what's so exciting about price elasticity in Bitcoin and the positive feedback loop that's created through Bitcoin bond issuance. And I think we're going to be able to see that again in Q1 of 2025 really start to kick off. Now, how fast it catches on, I'm not sure, but I can't wait for the free market to show us.
I was talking to the New Zealand Super Fund a few weeks back, and I know that they are investigating crypto. I don't know what that means beyond that, but you did touch on the fact that there's other sovereign entities that you're working with. Are you kind of expecting that you will be rolling out this sort of offering? We're not talking about just something limited to the U.S. here. Is this something that is going to be a global thing?
Yeah, this is going to be global. And what's interesting about the principal protection, I'll take a deeper dive into that portion of the product,
Yeah.
because it's dependent upon the issuer, right? So if the U.S. government is issuing the note, then it's U.S. government debt that makes up the principal protection. So that's been called the risk-free rate of return. We went through why that isn't necessarily accurate, but still, most lenders in the marketplace are going to consider that the risk-free rate of return. And from the viewpoint of principal protection, there's no better principal protection than a U.S. Treasury, because you're going to get paid no matter what. Yes, there's inflation risk because you just don't know what you're going to be able to buy, but you're going to get paid. In some other cases, you might not get paid. So it does depend upon who the issuer is. One of the countries that we're talking to is oil rich. So the principal protected note would be backed by the oil in the ground that they have. So that's a pretty good principal protection as well. It's probably even better than the printer when you really sit down and analyze it, because it's a real world asset. It exists. It's in the ground. They own it. They want to unlock that trapped equity and pull it forward. They want to pull forward that purchasing power with the Bitcoin bond issuance. And there's no way to attract that demand on oil alone. But when you combine it with Bitcoin, it's funny how we say Bitcoin is commoditized energy in the form of money. I think the oil industry and Bitcoin, which are both energy industries, are going to start to come together a lot faster than people realize, because Bitcoin is a way to unlock some of that trapped wealth and to pull forward that purchasing power, but in a way that benefits both the lender and the borrower. So that's, the principal protection does change depending upon who issues the Bitcoin bond. And that's what we do at People's Reserve. You come to us, and if you're the lender, number one, we source the borrowers because we represent the Bitcoin community, and we have the Bitcoin ideology that those who love and understand what Bitcoin is, we're representing that ideal within the marketplace. JP Morgan, Citibank, Wells Fargo, Deutsche Bank, they're not there yet. And I don't think they're going to be there anytime soon. And once they get there, are you going to trust them, or are you going to trust a Bitcoiner? So we're pretty confident in what we can do to source lenders and borrowers together and to add value to both of them. And especially when you're structuring this product, because we want to see your balance sheet. That's what we need to see. What does your balance sheet look like? How can we leverage your balance sheet to eliminate risk for the people that we're bringing, that you're going to borrow from? We're not here to screw over our community of Bitcoiners. When they lend to you, we want to make sure that this note is structured in a way where their principal truly is protected. And it could be backed by the printer of the United States if you want it to, or it could be backed by a real world asset like oil in the ground. So that, I think, is going to make a big difference in defining what the risk-free rate of return is. And when you have a Bitcoin bond pumping out 10, 12, I mean, just 10%, that's double the risk-free rate. If Bitcoin bonds pumped out 10%, at least you could break even. You can conserve your purchasing power. But we know with where we're going, with what they're going to be doing with rates and quantitative easing, and more liquidity injections, right? By definition, the problem becomes bigger and bigger. That's why quantitative easing 1, 2, 3, 4, it keeps getting bigger and bigger because by definition, the problem keeps getting bigger and bigger. So it's going to take more and more and more. And that's going to push the price of Bitcoin up through those inflationary price pressures, which pushes up the yield on the bond, which then secures your purchasing power for the insurance company, for the government, for the Social Security fund, for whoever has a need, like you said, to protect that capital for future deployment.
Got it. Amazing. And we'll finish up on this part here. If we think about a lot of people that might be listening and watching, this is probably light bulbs going off, hopefully, with a lot of people, because it certainly is with me. Like, you're crystallizing a lot of the things that have been fairly abstract in my head, but I'm starting to see things a lot more clearly here. A lot of people, though, still will be looking at Bitcoin as something that is a number go up thing to invest in. And so, to finish up on this, what do you see happening over the next 6 to 12 months with respect to the price of Bitcoin in light of things that we've been talking about, specifically the election, and that's going to roll out, and the side effects of that election after it occurs, maybe even geopolitical risk? What do you see happening? Because this is kind of like the next 12 months. We would expect to see something happen if the future persists like the past has, but that's not always guaranteed. What do you think is going to happen?
Yeah. So the first thing is that we know hash rate's going to go up because the public miners produce their projections, and hash rate is going to go up significantly. Now, hash rate has already been going up exponentially, and that trend will continue. And as hash rate increases, that increases difficulty, that increases the cost of production, which then pushes up the fair value. So that's an important concept because fair value will continue to grow. And I just want to, for your listeners right now, yeah, I know. Trust me. I know when I dig a hole in my backyard and it costs $100, it's not worth $100. All right. Cost does not create value. Value creates cost. All right. And that's what we're trying to define here. We're trying to define the value of Bitcoin through its price discovery cycle. And through that cycle, increasing hash rate is going to increase the fair value of the asset itself. And what's really interesting is that at the same time, not only do we have that fundamental positive price pressure, but we have $6 trillion on the sideline. This is more money than they printed for COVID sitting on the sideline here in the United States. When they lower interest rates, let's say they lower interest rates slowly. Well, some money is going to come off the sideline, come back into the assets. So everybody's waiting for this liquidity crisis, right? Everybody's going to, no, I need dollars. And no. We're going to have an asset crisis. There's going to be too much money and not enough assets to buy. And that is the definition of inflation: increasing money supply, increasing demand against a limited or even falling supply. And we've been in this inflationary environment for so long. And plus we have the fallout from the supply. That was like the big thing during COVID. Oh, it's the supply chain. Okay, well, did we fix that? I don't really think so, right? Russia, Ukraine still going on, some stuff going on in the Middle East, tensions between China and the United States, even though they're like economically tied together. They make the stuff, we buy it, we kind of need each other. All these tensions coming to fruition, and everything's worked great in peace times. But what happens as this stuff starts to fall apart? I think we're going to see an acceleration of these, let me call them reactions from the central authorities. So lowering interest rates. Trump before actually called for negative interest rates, which is a really interesting concept in itself. But what if he gets in? What if rates go negative? And then what if the Federal Reserve came out and started a demand destruction campaign. They fought against the economy when they should have been fighting against the currency. That means the government's going to have to pay to stimulate the economy that's been destroyed. The demand destruction campaign was successful. And when you deflate GDP by the correct deflator, by accurate inflation numbers, now your bookworms in there will know that GDP deflator is not the same as inflation rate, is not the same as CPI. We don't count imports in the deflator. But let me tell you, the same BS is going on. They're not properly deflating GDP. We've been in a recession since 4Q 2022, which is no surprise because they started raising rates in 1Q 2022. So there was a slight lag before the economy started to have a recession, which is what you would expect in a demand destruction campaign. But prices didn't really correlate with that because the government didn't listen to the incentives of the central bank. They continued to spend. And matter of fact, tax receipts were going down and spending was going up, so the deficit grew. So it created even more inflationary pressure. Plus, they're rolling over in the next 2 years 10 trillion of debt at an average of like 2.5% to where the curve is now between 3.5 and 4.5. So you're going to have increased interest rate costs, which are now the number 2 item. It was number 3 when I was doing shows earlier this year. It's now the number 2 item: Social Security, interest, Medicare. It's unbelievable how fast that expense, which was a non-item before, is now at the top of the list, even more than Medicare, even more than our military. And we spend more than our military than anybody in the world. So these costs create deficits, and deficits force inflation. They force debt monetization from the central bank. And even if the central bank isn't performing quantitative easing and they're performing quantitative tightening, when the government borrows money from the market and then spends it into circulation, it's not like the money that you lent them disappeared from your bank account. The principal amount is still there. You're expecting to get principal plus interest. So that money isn't destroyed. It's borrowed and spent into the economy and then repaid back to you. And how's it repaid back to you? With more debt monetization or from borrowing from other people. So it doesn't matter if the Fed is directly buying the debt or if they're borrowing money from other people to pay you back. It's the quantity of money is doubling because the principal stays in your account, but they get to spend it. So all of these factors are going to come together to create massive positive price pressure. Right now, we have negative price pressure from the demand destruction campaign, and we have positive price pressure from government deficit spending. And we have like a neutral price pressure for economic demand. But what's coming is lower interest rates. Lower interest rates means that all of that money on the sideline, that 6 trillion, it's now going to create economic demand. So that's going to create a positive price pressure. The economy is destroyed. The government's going to need to support it. Deficits are going to expand. That creates a positive price pressure. When people realize that we're not going to get some recession or depression, that they have cheaper prices to buy the dip, and then they really start rushing back in, that's going to be the blow off top of this entire bubble cycle, in my opinion. And that will also be the moment where it very well could be that trust is lost and we switch from an inflationary environment to a hyperinflationary environment. Again, I hope and pray that doesn't happen, but it's definitely a non-zero thing that could take place. So right now, if you're tuning in, you need to know, get your friends and your family ready. And by the way, even if you're a Bitcoin billionaire, that's not enough. You need to understand self-defense. You need water. You need food. You need security. You need barterability. You need community. So get out there, shake hands, meet your neighbors, unite together. It's not just a saying for the United States: united we stand, divided we fall. Humanity as a whole, united we stand, divided we fall. And now is the time to unite. Now is the time to see through the fake news propaganda that is designed to divide and conquer us and come together. And should we come together around one man? No. We should come together around truth. And Bitcoin is truth money. It's economic truth. And if we come together around Bitcoin truth, we really can become united and have a positive future that's better for us and our kids and our great grandkids. We'll have something to be proud about going into the future rather than passing off a problem and kicking the can. Forget kicking the can. Let's pick the can up, let's fix it, and let's remake this thing so that we have a bright orange future to look forward to.
That's awesome. All right, a bright orange future, and hopefully it's not napalm, right? It's actually
Bitcoin orange, not fire orange.
There we go. Thank you very much. There, just to clarify that. That's awesome. Now, where can people go to follow you? I know I've been following you a lot on X lately, been stalking you a little bit there. Where's the best place for people to hear more about your content?
Yeah, so I'm most active on X. I don't really do the other stuff. So I'm on X as at CJ Konstantinos. I'm sure you'll put it in the notes or in the link below. And I'm also on YouTube with the same handle, at CJ Konstantinos. And those are the best 2 places to get in touch with me. I also have Christian Investment Analysis, where you can model my portfolios and read my market analysis. It's up to you. I don't push any of these things. All I do is produce value and welcome you to the community. So any one of those ways is the best way to follow along and hear what I have to say. And if you really like what I have to say, to even model your portfolio after mine, because what's coming is coming fast, and it's coming a lot faster than people realize. So it's definitely time to take the right steps, to follow the right people, to listen to the right podcasts, and to share this information with everybody you can, because you don't want to be in the middle of this thinking, I should have told my uncle, or I should have told my cousin, or I should have told my neighbor. We need to unite now together. So thank you for everything you do and for having me here today to spread this message to help orange pill the world.
Awesome. Appreciate that one. Thank you very much.